Everybody, this is Seth Martin. Welcome to Middle Class Investor. Thank you for joining me today. Well, we've got our trusty little rising wedge up on the screen here, and the market got back to the top of that rising wedge, and you can see that it's beginning to struggle quite a bit. Of course, that happened back here. It didn't happen with as much energy as this past week, but we have seen it break out of this and then jump back into it. As you can see, there's not much left in this rising wedge, and I've talked about this before. I'm not sure if we can actually still look at the rising wedge, but these trend lines, especially this top trend line, is still very important. It's the trend line that connects the all the highs from this latest bull run since 2009. And we're looking at a weekly chart here, and you can see that we had a pretty strong sell-off. So, the market, we had a pretty strong run-up, and we've taken, about 30% of this run-up away just in 1 week. And, volatility is up in the market. It looks like the market is wanting to, do something a little different than just go straight up. And, I think we need to watch it closely. Last week we looked at the VIX, and we noted that the VIX broke through this trend line, but also said that, it wasn't likely to stay below this level long. This 12 level is a level that if you go back far enough, you'll see that the VIX really doesn't get below that very often. You can see here, this is 1250 line right here, and we've had some excursions below it, but it doesn't stay there long. So, and it didn't in this case either. It kind of got below there and then got right back up last week, and is charging higher. So, it looks like the other thing I want to note about the market last week. Let's look at a daily chart of the S&P 500. It finished at the low. So when I hold this here, if you look up here under low and close, these two numbers right here, L and C, when I hold the cursor here, you can see that the low was 2002.33 and the close was 2002.33. This is, I don't know, I don't see that very often, so I didn't know what to make of that. That just means probably there's more weakness for the open on Monday. That's kind of what I take it to mean. Who knows? The problem with this, this run up, because it kind of ran up straight up, there's not a lot of support areas on the way down. So your major support area is basically, the support area we have drawn here, this one right here. This support area right here. Now there was some minor support right under this candle here. So, beginning at around 1985 to, maybe 1975. 10 points here below the week of November 3rd. So that's kind of what I see on the S&P 500. The Dow looks very similar. The difference in the Dow is this line doesn't just connect the highs from the 2009 low. This line right here connects the highs from 2000, the dot-com bubble, and the financial crisis. And you can see we got above this line, came down, got above it again, came down a little harder, got above it higher, and looks like sometimes I've seen this happen before where there's an important area, and usually the third time is the charm. It gets above an area, and then it sells off, gets above the area again, sells off, and once it closes below that area a third time, it usually doesn't come back, for a long time. So if we see on the Dow, if we see this line right here, it's red. If we see that break, that could be this could be the high for some time. You know, there's no way to really know that. It's just something that I've observed. If you have an important area and it bumps up against it, you usually don't have a fourth, a quadruple top. A triple top is about all you can get out of the market before some heavier selling comes in. Let's look at the euro, US dollar. If you'll recall, last week we were talking about this line likely holding because there's this larger consolidation pattern here that we were looking at. And for the time being, that looks to be the case. The euro, appears to have bounced off this line. And I would say if you're looking for, let's just go ahead and move this support zone or this resistance zone. If we're looking for a place for maybe the euro to go to, I would say resistance is right about there. So what I'm looking at is I'm looking at this candle and the high of this candle. A lot of times the market will, obviously this high is probably one as well, but I think for the larger pattern, this is probably the bounce area that the euro would likely go to. And then it could go through that, or this could end up being resistance and it rolls back over. So we'll just have to see. But it looks like the euro, the trend is definitely, the bigger trend is definitely down. And, we've talked about potentially the euro going to parity with the dollar. So that would put it, where the dollar and the euro are equal at one. $1 buys €1 type thing. You can see this is Sunday evening right now, 7 o'clock Houston time, and you can see that the market is open right now, and the euros, well, you might not be able to see because the recording line goes to only looks like the second or third digit. So, but maybe you can see up here that the euro is moving currently right now. It's 124.55, and it's down, 5/10,000ths of a point. Since we're talking about the euro, we can look at Germany. This is the EWG, and you can see that last week we got right up to this trend line. This is this red line right here is a 30-week moving average, and the blue line is a 50-week moving average. And you can see they crossed here, and that's pretty important. You don't see them cross very often. You can see the cross took place here, and they had a pretty dramatic sell-off, and then it bounced up, and then it crossed again. And then really, the red line has been above this blue line for pretty much since late 2012. So the fact that it's crossing down is probably, at least in the near term, is not a good sign. We'll probably get some sort of bounce and then another resumption to the downside. I don't know. When I was looking at this before, to me this looked very corrective, and it looked like maybe Germany can make a new high. And I'd still say that that's a possibility. EWG could make a new high here. But given the weakness in the commodities, the oil sector, gold, this could be, the commodities could be kind of forecasting some overall global slowdown. That seems to be what's happening. So if we look at Japan, Japan's kind of a mess. They've really are working on destroying their currency to try to inflate away their debt. I think their debt to GDP is like, I don't know, it's like 250% or something. And governments really, when they get into that situation, they don't tend to honestly default. They don't tend to say, hey, we can't pay our bills. What they tend to do is make up a reason to print more money to devalue the debt. So it's basically a transfer of wealth from the lender to the borrower. So, and that's typically what governments do. That's why they like inflation, is because over time what it allows them to do is spend more than they can collect in taxes. And Germany's no different. I mean, all these countries are the same. They basically promise things to voters to get elected, and voters basically fall for it and say, yeah, we'll vote for you if you can give us free health care, or you can give us free, retirement, or whatever it is they're offering. But the reality is actually something different than that. I mean, there are no free lunches, as they say. So this is the United Kingdom. The United Kingdom, to me, the chart looks a little bit more bearish because it did break out of this channel here, and then you can see last week was a pretty good route. I mean, it took out, what is this? 1, 2, 3, 4, 5, 6, 7 weeks of price value in 1 week. I mean, that's pretty substantial. So I'd say if this support area here doesn't hold, you could see you got the support area kind of right in here. But if this doesn't hold, you could see the UK go all the way down. Well, I mean, all these areas are support. There's support under this low. There's support under this low. But this looks like such a large sell-off that maybe it might end up retracing this whole move. But it's not going to do that in one fell swoop. It's probably going to come down, maybe to these areas of support, kind of correct back up, and then come down and take out, say to this low or something. So it looks like there's just a lot of risk in the market all over. Here's the global Dow. It looks a lot like the UK. You've got a hard break, a retest, and then a really hard. I mean, look at this. This is look at all the time it spent. 1, 2, 3, 4, 5, 6 weeks going up, 7 weeks going up. And literally in this last week, it took out that week, that week, that week, that week, that week, and almost all of that week. And so, you might get a little bounce next week and then have this resume to the downside, and you might see in the near term support in an area like right there. We've already looked at volatility. We could look at interest rates. I think the interest rate market is key, and I think it's at a very critical point here. Just to review real quickly, we're operating under the assumption that this is possibly the low, and that this is the first move off the low, and that this is the first correction off the first move of the low. So if that is the case, then this next move, just relative to this move, relative to this up move, is usually at least 1.5 and sometimes 2 times as large as this move. So this move was 1.4% to, let's just call it 3. Let's call this 1.5%. So if this move is double that, then you're talking about this move being a 3% move, say from this area. That would take you, let's just call it 2, that would take you to about 5%, 4.5%, 5% on interest rates, the 10-year Treasury, 10-year U.S. Treasury. And that would be significant to our economy. We've kind of become accustomed to these very, very low interest rates, and a move, and that move could be very rapid too. That's the other side of the coin. And the reason I think we're at a critical juncture here. Let me go to a daily and let me show you what I'm seeing here. This would all be correction, into this low. And let's just talk a little bit about what actually happened right here. So if you think about it, this is the inverse of the bond market. So let me just flip this upside down. Okay, so let's just hold it there for a second and talk about that. What happened is people flooded into bonds, okay? And somebody bought bonds way up here, okay? And then the market just sold off hard. So what you've got is you've got almost like a panic top, okay? And then you've got this correction back. So we sold off and we're correcting. Let's go back. So this move here is people buying bonds, okay? Rates are going down. And it's almost like a panic. It's not almost like a panic. It looks like panic buying all the way down into this area. And then, so the market's like a spring. The spring got stretched really far. And sellers could see that, hey, these guys are buying our bonds at any price, and so they start making offers below the market, and you get this long stretch, okay, and then you get this heavy snapback where the buyers go, hey, you know what, we're not buying anymore, we've bought enough, and so you get this heavy snapback, and then you get this correction, and this correction, this little zigzag move here is just a smaller and less complicated version. Let me go back to the weekly of this right here. This is also very corrective looking because it's chopping back and forth and everything. And so this whole correction all the way down to here is just a larger move or a larger version of this smaller one here. But you can see it's pretty simple. And so I mean, it's possible that, you know, the 10-year Treasury could pull back even to, say, a low just below this low. But what you're gonna see here, when you have a really long tail like this, there's not a lot of support, or there's not a lot more buyers. Or if you're looking at it like this, if you're looking at it upside down, there's not a lot more buyers as you get closer and closer to this, to these tails here. It's almost like a gap. And so what happens is a lot of times when you see a pullback like this, you'll see the market spring really hard off of that. And so I'm looking for treasuries to pop from here, and or from slightly lower than here, maybe down in this area. But it could be it could make the market really, really nervous, because you could see the interest rates move to, say, this 2.7, 2.8 area, maybe even higher, maybe 2.9, very rapidly before we get a little pullback, and then another move higher. So this interest rate market, I think, is a key one to watch if you're trying to figure out, you know, what direction is the equity market going to go. And I think the equity market is already kind of started to sniff this out, and this is what you're seeing here. Of course, you know, tomorrow we could get a, you know, you could get a, let me zoom in here a little bit. You could get something like, and let me do a little bit better than that. That's not that great. Let me zoom in like this, and then zoom in like this. So, you know, Monday you could get some sort of gap in this area. Like this, that was like an inside week. And then if that happens and you get the next week you get a one that looks like that, this could quickly go to new highs. So, but let's just assume that, you know, this is broken out and it's going to continue down a little bit. You know, there's nothing really to do until it comes down and makes a a low somewhere in here, and then comes up and makes a lower high, and then rolls over, and then that kind of creates an event where we got to take action. So for right now, there's nothing to do except watch and wait, and I think the interest rate market is really key to what's going to happen here. Let's just take a quick look at Forex Factory and look at the news stuff that's going to happen next week. It looks like Monday we're going to have some monetary policy meeting minutes. I don't think there's a whole lot that's going to surprise the market there. Of course, you never know what they're going to put in those things. But and then we've got just nothing really big, and looks until like Wednesday. I think you get some crude oil stuff on Wednesday. You get an FOMC statement. So there is some news next week you need to kind of watch out for. One of the other things for y'all that are looking for you guys that are looking for places to read good stuff, this David Stockman's Contra Corner is pretty good. You might want to take a visit on that. David Stockman was the OMB director under Ronald Reagan. He was also a congressman. He also has a financial background, and he's doing a lot of truth-telling in this blog, and I think it's a pretty good place to go find good information. And with that, that's it this week. Look for the market to continue selling a little bit before we get a bounce. In fact, I tell you what, we can go look at the futures real quick. I've got stuff open here. Let's look at the daily. So you can see that, crude oil is down another 1.5%. So crude oil is not through going down. And you can see that the market, the actual stock market, is bouncing here a little bit. It's about 5.5 points higher than it was when futures closed on Friday. So maybe we get an up open, but it looks like so far all these up opens have been sold off. So just expect a little bit more selling until this crude oil bounces or things quiet down in that market a little bit. All right, everybody. Thanks for joining me this week. We'll see you next week. Take care.